let's kick off with the decision by the CBK yesterday. We know that the inflation rate has come down substantially for the last few months. For 4 months, it's been falling, sitting at 15.6%, but the CBK keeping interest rates on hold, citing the fact that there's festering concerns around inflation as a result of food prices and oil prices. So in your view, do you think another prudent decision by the CBK?
I think going by what they said in last month's meeting, then it was expected that they would continue tightening or keep maintaining it at 18%. The key thing, if you look at inflation and CPI figures, that there's been a clear decoupling of the CPI and as well as the inflation. So the inflation right now is a factor of last year's base effects rather than prices actually coming down or prices the growth in the prices slowing. So there's still inflationary effects in terms of people's real incomes, and that's why they're maintaining interest, the CBR at 18%. And I think what that will happen is that from the forex front, a lot of people are holding back last week in anticipation of yesterday's decision, but now you expect to see more people coming in, especially given that there's going to be support for the current yield environment in Kenya.
So you expect shilling strength on the back of that, but as I was mentioning, you're looking at resistance, which is looking quite strong at around 82.50. Importers tend to be coming into the market at around that level. So how much can the shilling strengthen from here?
In terms of how much it can strengthen, we are seeing a level of at least 81 if the CBR maintains over the next 2 or so months, because for one, import demand usually comes with a lag. What happened in the last quarter of last year is people now had to adjust their inventories, and such lagged import demand did not come into the shilling equation around this time. So we expect to see imports slowing down significantly, and already you can see from the imports of cars and the registration of cars at the Kenya Revenue Authority, it's slowing down. And for another thing is that import duties have slowed down significantly, and I think the KRA has only managed a revenue collection of 86% against target. And if you look at the same time last year, I think that collected 93%. So it shows that slowly the effects of the monetary policy are filtering through into the economy, and of course the shilling is going to benefit from that.
And let's look though at the big concern for many is that current account deficit, and many saying that structural imbalances are just too deep. You've got the deficit, which surged to $4.5 billion last year. That was a 13% deficit of a gross domestic product. Now, if you look at that on a global scale, we're always talking about Greece, we're talking about Spain, but Greece's deficit last year was 9.8%. So Kenya really has a deficit problem, and that is a big concern. Is that something that is set to improve? Is that something that the authorities have a handle on, in your view?
I mean, making parallels to Greece wouldn't be exactly the way to go, especially because Kenya has control over its currency, and that's the key difference. And going forward, one thing that we are likely to see is that the good thing, if you look at the structure of imports, or the positive thing, is that a lot of the imports are capital equipment. And of course, if all goes according to plan, especially with the Vision 2030 master plan, then you're going to have a solid industrial base going forward that will make up now for the exports. So at the moment, it is a concern, but it's not as huge a concern as most people would like to see it. As long as the capital equipments are the key imports, then I don't think it's a massive concern.
Okay, so that is a sign, as you say, of fueling infrastructure growth, and that will, of course, be a positive for economic growth. Let's just look at your outlook for decisions in terms of interest rates and the turn in the interest rate cycle. Some analysts saying that the next move is lower, but some are saying that we will have to wait to see an interest rate move lower for the end of the year. In your view, what would need to change to make the CBK more comfortable with easing right now?
I think right now in our environment, you have to go step by step, and you can't make very long-term forecasts, because a lot of things there's dynamism everywhere. For one, we would like to see a real slowdown in non-core inflation, and whereas the price of hotels and non-core items in the CPI, when there's an actual slowdown and actual reversal of the gains in prices, then that could be a pointer to slowing down for the CBR to take significant action with regards to lowering the CBR. So I think once we start seeing a steady decrease in non-core inflation, then that will be a key. I think for going forward, that's the key thing to watch out for, as well as, in terms of things that are endogenous to the economy. Of course, the rains have already started, and hopefully that will feed into lower food prices going forward. And fuel prices are exogenous. So I think the key thing that the CBR will be looking at is non-core inflation.
Let's take a look at one of the stocks that has come through with some news in terms of deal flow. Kenya Generation coming out saying that it signed that $140 million deal with China's Sinopec International Petroleum Company. That's for gas pipelines for its geothermal power plants. That company is set to start building those power plants, and those are set to come online mid-2014. So would you be getting into the stock at these subdued prices right now on the basis of that medium-term, longer-term outlook for growth?
I think right now, with regards to Kenyan, you've got two options. You can either get into the equity side or buy the bond. And I think right now, given the discount that's being applied to the bond and the fact that they have good interest cover, then looking into that exposure with Kenyan, I'd rather go into the bond, given the uncertainty into the market. However, as you said, there's a lot of potential for Kenyan, selling around 7 shillings right now, 7.45. So I think there's a huge discount being applied to it. And once the market recovers, then we could see significant appreciation, just as we saw with the Chumi.
Before I let you go, Samora, before we, of course, go on holiday for the Easter break, would you be buying any stocks in the market today, any stocks that have caught your eye as offering attractive levels right now?
I think a lot of the stocks that in the year we started out looking at, we looked at KCB, we looked at Chumi, we looked at equity. I think right now there's a lot of interest on that. So I think right now just go and enjoy my break and come back and view my options thereafter. Well, at the moment, I wouldn't give very strong stock tips at the moment.